Good afternoon, students. In the afternoon session, I have decided to take holding company. Why I have decided to take the class on holding company in this afternoon session? You are 6 semester students. You belong to 6 semesters, and this chapter is very important to you under the 6th semester, and you have to make yourself ready to practice and note down what I am telling you slowly and lucidly. A holding company controls one or more companies by way of holding majority of voting shares. You know, voting shares, equity shareholders have got the voting rights, and majority of the equity holdings to be held by the holding company. And secondly, enjoying the power to appoint the whole or majority of the directors there. Is this clear? A company under the control of holding company is called a subsidiary company. Subsidiary means the company which is under the big company, and the company which is holding lesser number of shares, certainly less than 50% of voting shares. There are 3 ways of acquiring such control. Number 1, by holding more than 50% of voting shares in subsidiary company. Secondly, by controlling the composition of the board of directors of subsidiary company. And 3, by controlling another holding company which further controls any subsidiary company. The holding company has a separate legal entity. The subsidiaries are also distinct and separate entities. The relationship between these companies is a form of combination. The holding company together with its subsidiaries form a group. The definition of subsidiary company is under Section 4, Clause 1 of the Companies Act 1956. As per Section 42, Clause 1, a subsidiary company cannot hold any share in the holding company. So, Companies Act is very important. Under this Act, there is no need to prepare combined or consolidated final accounts of holding and subsidiary company in the books of holding company. But holding company attaches the copy of balance sheet, 1 copy of profit and loss account, and 1 copy of audited report of subsidiary company with his final accounts. But for showing true financial position, often holding company prepare consolidated balance sheet. We are students of commerce. Certainly gather some knowledge how to prepare this consolidated balance sheet. It is easy to understand that consolidated balance sheet is a balance sheet in which all the assets and liabilities of holding company and subsidiary company are added with each other, but practically it is tough to make consolidated balance sheet of holding and subsidiary company. Rules for the preparation of consolidated balance sheet. If we want to prepare consolidated balance sheet, we have to know certain rules. In short, CBS, that is consolidated balance sheet. In the CBS, investment of holding company in equity shares of the subsidiary company is replaced by the assets and liabilities of the subsidiary company. The holding company in its own balance sheet shows the shares acquired in subsidiary company as investments. It is represented by the net worth or equity of the subsidiary and the holding company share in such equity, where equity equals to share capital plus net reserve and surplus on the date of acquisition of control. Acquisition of control date is very important because on the basis of this date of acquisition, we have to calculate pre-acquisition profit and post-acquisition profit. Just remember, the excess represents as goodwill. Again, I repeat, equity equals to share capital plus net reserve and surplus on the date of acquisition of control. If cost of investment is greater than equity, the excess represents as goodwill, or vice versa. Vice versa in this sense, if the cost of investment is lesser than equity, the difference is shown as capital reserve on the liability side of the CBS, that is consolidated balance sheet. Am I clear? What I am telling theoretically, that is practically you have to remember while you are preparing consolidated balance sheet. Now we have to follow certain steps for preparing consolidated balance sheet of the holding company and its subsidiary company. First step, add all the assets of subsidiary company with the assets of holding company. Okay, but investment of holding company in subsidiary company will not be shown in the consolidated balance sheet because investment in subsidiary company will automatically adjust with the amount of share capital of subsidiary company in holding company. Okay. Second step, add all the liabilities of subsidiary company with the liabilities of holding company. Very simple. But share capital of subsidiary company in holding company will not be shown in the consolidated balance sheet in the books of holding company, because this share capital automatically adjusted with the amount of the investment of holding company into subsidiary company. Am I clear? Next, third step. Calculate minority interest or calculation of minority interest. First of all, we should know what minority interest is. Actually, we have to know what is minority interest. Let me say minority interest is the shareholder, but there is not holding company shareholder. So when holding company shows consolidated balance sheet, that is CBS, it is the duty of accountant to show minority interest in the liability side of consolidated balance sheet. Okay? We can calculate minority interest with the following formula. You just note down. I am slowly speaking. Take your exercise book and note down the steps. These steps have to be remembered by you while you are preparing consolidated balance sheet CBS. So formula is total share capital of subsidiary company. Total share capital of subsidiary company, rupees so and so. Less investment of holding company into subsidiary company. Okay, less investment of holding company into subsidiary company amount. So from total share capital of subsidiary company, you are deducting the investment of holding company, you are getting figure. And with that, you add proportionate share of the subsidiary company's profit and reserve or increase in the value of assets. Less proportionate share of the subsidiary company's loss and decrease in the value of total assets of the company. Then you will get value of minorities interest. Okay. Fourth step, calculation of cost of capital or goodwill or capitalism. If holding company purchases shares of subsidiary company at a premium, then the value of premium will be deemed as goodwill or cost of capital and shows as goodwill on the asset side of the consolidated balance sheet. But if holding company purchases the shares of subsidiary company at a discount, then this value of discount will be shown as capital reserve and must be shown in the liability side of the CBS, consolidated balance sheet. So fourth step is over. Fifth step, treatment of pre-acquisition of reserve and profit. I told you that date of acquisition is very important. Before the date of acquisition, all transactional profit will be treated as pre-acquisition profit. And after the date, whatever profit or loss sustained will be treated as post-acquisition profit or post-acquisition loss. Okay? So, treatment of pre-acquisition of reserve and profit. Let me say pre-acquisition profit and reserve of subsidiary company will be shown as capital reserve in consolidated balance sheet. But the value of minorities profit or reserves deducted from it and add in minority interest value. Total profit before acquisition of subsidiary company equals to total profit before acquisition of subsidiary company equals to amount. From this amount, less share of minority interest that you have already calculated in the earlier step. So value of profit X minority interest value of shares in subsidiary company or total share capital of subsidiary company. Pre-acquisition profit and reserve shown as capital reserve. I think fifth step is over. Sorry, again come back to sixth step. After the fifth step, we have to note sixth step. What is the sixth step? Calculation of post-acquisition profits. After the date of purchasing the shares of subsidiary company, profit of subsidiary company will also be deemed as holding company, as of holding company, and it include in the profit of holding company. And we also separate the part of profit of minority interest and add in minority interest value and to be shown in liability side. So sixth step is over. Should I repeat? Okay, again slowly I am telling you sixth step. Repeat. Calculation of post-acquisition profits. After the date of purchasing the shares of subsidiary company, profit of subsidiary company will also deem of holding company and it include in the profit of holding company and will also separate the part of profit of minority interest and add in minority interest value and to be shown in the liability side. Let us come to seventh step. Elimination of common transactions. There are certain common transactions that elimination is necessary. All common transactions between holding company and subsidiary company will not be shown in the consolidated balance sheet. They are following common transaction. Number one, goods sold and goods purchased on credit and the value of debtor or creditor. Either subsidiary company or holding company will not be shown in the CBS. Okay. Second, value of bill payable or bills receivable of holding company on subsidiary company will also be not shown, but if some bills value is discounted from third party, then either of both companies' payable value shown as liability in the consolidated balance sheet. Okay. So come to eighth step, treatment of unrealized profit. This treatment should be noted if subsidiary company sells the goods to holding company or holding company sells the goods to subsidiary company at profit, and if such goods will not sold in third party, then the profit will not be realized. So such unrealized profit will not be credited to profit and loss account. As this time a stock reserves account is open and all amounts of unrealized profit transferred to this account, and these accounts total amount is deducted from closing stock of consolidated balance sheet. Suppose closing stock of H Limited 50,000. Closing stock of AS Limited 50,000. Total comes to 1 lakh. Less stock reserve 2,000. Comes to 98,000. If subsidiary company has also other outsider shares, then holding company makes reserves up to his shares proportion. Ninth step, treatment of dividends. If holding company gets the dividends from subsidiary company, then this will divide into two parts. If subsidiary company declare dividend out of capital profits, then these will add in capital reserves in consolidated balance sheet. But if subsidiary company has declared the profit out of revenue gains, then this dividend will be added in general profit and loss account and will be shown in the liability side of the balance sheet. Thank you. These are all steps must be considered and must be studied very carefully so that you can prepare consolidated balance sheet very efficiently. This is not at all difficult. If you study after noting down what I have said, definitely I believe you will be able to do this squarely. Thank you.